On these iron ore plays, as James has just mentioned, you've got the bounce back in the iron ore price overnight, but you've also seen bounce back in Fortescue shares. They're up 4.5%. We didn't see that yesterday. What's the trend going on? Because yesterday they were headed the other directions.
I think you're seeing a little bit of cautiousness in Fortescue, and that's despite the 15% bounce back that we've seen in iron ore prices since Thursday now. But with signs that the iron ore price has bottomed, it should be good news for single commodity miners like Fortescue and the likes of Atlas. What's really held back Fortescue the last couple of sessions is speculation that it may need more capital. At the end of 2011, it had about $3.7 billion worth of debt. But of course, with capital expenditure expected to peak in either this financial year or the next one, we're expecting to see its net debt rising to about $9.5 billion by the end of the current financial year. That's despite Fortescue scaling back its expansion plans from 155 million tonnes by the middle of next year to 115 million tonnes, and of course scaling back its capital expenditure plans as well, cutting it from $6.2 billion down to $4.6 billion. A capital raising, I think, would be difficult for Fortescue, and that's because Twiggy owns almost 1/3 of the stock of Fortescue, and it's unlikely that he'd be able to raise the funds to fully participate in a capital raising by Fortescue, and probably doesn't want to see his stake being diluted. So what we could see if we continue to see softness in iron ore prices is a sale of assets. We've already started to see the start of that, but if we were to say sell down its rail infrastructure assets, it could raise up to $2.5 billion there. So I guess speculation on Fortescue and the need for capital really holding back the share price of Fortescue the last couple of sessions. But really it is dependent on iron ore prices. If we continue to see iron ore prices strengthen, then a lot of that concern is going to disappear.
Of reluctance to be more broadly involved even in the market that kind of you can see in those volumes at the moment?
I think we are seeing volumes a little bit anemic, and that's just because of the event risk happening this week, and of course we're watching the German constitutional ruling. But a positive for the market is that we did see an attempt to delay that ruling being knocked back, and of course the FOMC and hopes around quantitative easing. But in terms of commodities, the price action has been good. We've seen iron ore prices up another 4.4% overnight, copper prices up by 0.2%, and recently we really have seen copper prices breaking out, so that's helped the likes of BHP Billiton and some of the other base metal miners as well. A lot of that has to do with China. Last week we heard of that 1 trillion yuan stimulus package. Well, we heard some more comments coming through from Premier Wen overnight saying that he will put a floor on the growth rates in China, and that he will do what's necessary to hit that 7.5% target for 2012. And if necessary, he does have access to a 100 billion yuan fiscal stability fund, which he's willing and able to mobilise to help growth in China. So those type of comments really helped the commodity plays, and we did see an uplift overnight. But all up, it does look like a little bit of a risk-on environment. We saw the S&P 500 up by 0.3%. That's despite Moody's coming out to threatening to downgrade the US credit rating if a long-term plan is not in place to reduce the deficit in the US by the end of the year. And we also saw most of the commodities rising as well. So all up, it does look like a good day for the Australian market ahead of that ESM ruling by the German Constitutional Court tonight.
Julia, just on expected stimulus, further stimulus from China, I mean, it's a bit more difficult than just throwing money at the economy, isn't it? I mean, yes, they have a huge war chest, or at least they lead us to believe they have a massive war chest in terms of cash and fiscal might to throw at it, but because they have issues with bubbles dotted throughout their economy, they need to be careful, don't they, in terms of how they target stimulus?
Well, one thing we saw throughout the global financial crisis is that 4 trillion yuan stimulus package did create bubbles in the Chinese economy, in particular in the property market, which has been deflating. And if we see the pain of that through the Chinese economy, well, we can see that in the GDP numbers and the slower growth numbers. Property investment is a large portion and has been a large portion of the growth that we have seen in China. But of course, the government doesn't want another property bubble, and that's why it's been quite cautious in where it spends the money. We have seen reserve requirement ratios coming down, and that's added about $190 billion towards new lending, and we've seen 2 interest rate cuts this year. But all up, if we have a look at the stimulus, it is mainly in the areas of infrastructure, I guess hoping to avoid those property bubbles. But the thing with infrastructure is that it does have a slower rate of impact to the economic growth story in China. So an average spend of 4 years, it is spread out, but all up in general, it should be good news for commodity prices. And I think that's a key reason why we've seen the iron ore price jumping 15% from the lows we saw last week.
Peter, maybe we can